moving averages are one of the most fundamental tools in day trading. In today's video, we're going to learn all about them. EMAs, SMAs, 9 period, 21 period, 200 period. What is that? We'll also go through how to add them to your chart, and I'll show you a really simple strategy you could try out with them. I don't know if I would call this a masterclass in moving averages, but if you're a beginner, this is a great video to watch and it'll give you a solid foundation in moving averages. Okay, so what is a moving average? Basically, they're these lines you see on price charts all the time, kind of go with the candles. It's a moving average. This is basically a tool to see a smoothed out version of price over the last whatever time frame. These don't provide any magical data, but they do make it a little bit easier to read your charts and see trend directions. So the way they work is they take normally the closing price of however many periods or candlesticks, and they average them together. So let's say you're looking at a 10 period moving average. That means for the last 10 candlesticks, whether it's a 1-minute candlestick, a day candlestick, whatever, the moving average is going to show you the average of those last 10 prices. So you'll be able to see if price is going up really quickly. You can see if price is going down really quickly, that kind of thing. You might say to yourself, well, couldn't I just look at the candles to see if they're going up or down? And obviously you can, but moving averages are going to give you a really simplified view and even out a lot of irregularities. Okay, so there are two major forms of moving averages, SMAs and EMAs. SMA stands for simple moving average. This one is really straightforward. If it's a 10 period SMA, they take the last 10 closing prices and they average them together, and that's your price for that point of the SMA. EMAs, exponential moving averages, are a little bit different. They use a little bit more complicated math to more heavily weight more recent prices. So what that means is EMAs are going to be a little bit more responsive. So both of these are great tools. You'll probably see EMAs a little bit more often, but they both have their place. So one fun way to think about moving averages is they're kind of like organic trend lines. If you were to draw a trend line over a bunch of highs or a bunch of lows, you'd get a really static line, right? It's your interpretation of all the highs. And trend lines have their place. Moving averages will provide you a lot of that same data, provide you a lot of the same support and resistance. But one, you don't have to draw them. And two, they kind of ride with price a little differently. The biggest advantage is that you can stack multiple EMAs of different time frames really easily, which you can't do with trend lines as well. But we'll get into all of that later. Like everything else, trend lines have their place, EMAs have their place, but EMAs provide a lot of the same value as trend lines. So what are some common time frames you're going to see for EMAs? As a note, when we say things like a fast EMA or a slow EMA, fast EMAs are really short time frames. So like a 9, a 21 period, those are pretty fast. A slow EMA is something like a 100, a 200, whatever. Because they're averaging in a larger time frame, the slower EMAs react to price more slowly. So the 9 EMA is probably the fastest one you're going to see. It's going to hug the candles pretty closely. You might use it for scalping, but it's really not going to work well in a choppy market. A 21 EMA, you're going to see all the time. It's probably my favorite to leverage, and it's a good sweet spot between being pretty quick, but having a little bit more flexibility than the 9. You might also see a 50 EMA. This is more in the middle, definitely getting to be a slower EMA, and you're often going to see this as like a middle point to take a look at. When you see a 100 EMA or a 200 EMA, we're talking about long-term trends. These are slow EMAs. A 100 or 200 is really going to show you a macro trend. If that gets broken, there's a really big shift happening. So you can see how these are all reacting differently to price. One really easy way to see if a market is trending is to see how far apart these lines are. In a market that's choppy, not really trending, they're going to be almost on top of each other. Depending on your strategy, you may not want to get involved in that. A trending market is going to have a lot of space in between these lines. What that tells us in this example is that the price over the last 21 candles is a lot higher than the price over the last 100 candles. And we can use that to see how aggressive this trend is. Now I'm going to show you how to add these to your charts in TradingView. So if you want to add these indicators to your chart, you're going to go up here to indicators and search for EMA, moving average exponential. That's what you want. The first thing I want to do is show you the difference in an EMA and an SMA. So moving average simple. All right, these are both defaulting to a 9, which is really fast and kind of hard to see a difference. So let's change these to 21s. Let's make this one green this EMA, and let's make this SMA also a 21. But let's make it, I don't know, yellow. All right, so we can see these are pretty similar. The difference here is that this green EMA is a bit more responsive to price. You can see like when price started this downtrend here, it's a steeper curve. And the SMA does eventually catch up, but that's really the difference here. EMAs are going to respond quicker. Most of the time we're going to use EMAs, but not all the time. And honestly, in most cases, you would see pretty similar signals, but it's just something to keep in mind. All right, so that's EMAs versus SMAs on a chart. And now I'm going to show you what different EMA timeframes look like. So we're going to add 3 EMAs. And let's make this one thicker. We open up the color, go to thickness. And then we're going to do a 21, a 50, and a 100. Just to make this a pretty standard setup. People use this all the time. I didn't actually make this a 50. There we go. And we're going to make this one 100. So we have a fast, that's our 21, a medium EMA, that's our 50, and then a slow EMA, that's our 100. All right, let's make this one red. I actually do this green, yellow, red pattern kind of a lot. I just find it really easy to look at. So, okay. So we can see our green 21 hugs price really closely. Our 50, it's more in between. And our 100 is much slower to react, right? It's much more gradual lines. One of the things we use EMAs for are to see trends and to see how strong trends are. So here, this is a pretty strong trend, right? Our lines are really far apart. We can see price is diving really quickly. Price is staying outside of the 21. That's a strong trend. It's just moving. Over here, we can see that price is consolidated. There's some movement up and down, yeah, but like these lines are so close together, it gives us a really quick visual indicator that there's no trend happening here. You can see there's a trend that starts a little bit, but this is a much weaker trend. The lines are starting to come apart, but they're not very far apart. Here's another big dive. Boom. So you can use these lines to see trends really easily. So the next thing we're going to talk about are crossovers. So you might hear someone say when a fast EMA crosses the slow EMA. What they're talking about is something like this right here. So we can see there was a really brief uptrend here. Price zipped up and then it zipped back down. And one way to quantify that is to look at this EMA crossing the yellow, right? This fast EMA said price is moving quickly and it went under the 50 EMA. Like I said, it's just a way to quantify price, right? Like we can also look at the candles and see, yeah, price is going down. But this is a very alertable thing, which is nice. That's a crossover. You can see another crossover here when price went back up, zipped up. This is a good example of a breakthrough. So sometimes you'll see a really sharp change in direction like this. When price broke through the 21, the 50, and the 100, like this is a really intense change of direction, really intense trend change. You can see it happened here, boom. And you can see it happened here, boom. And then it consolidated for a while. Okay, I promised you a really simple strategy. This is the 21 EMA bounce. Just because it's simple doesn't mean this can't be really effective. If you're a beginning day trader, this is a great one to start with. So you're going to have the same setup, a 21, a 50, and a 100 EMA. And what you're going to do is look for bounces on the 21. What I mean when I say that is something like this, right? We're in a strongly trending market. This is really important. We have the lines are far apart. We don't want to, if you see this, this is no good. The lines aren't very far apart. This is not a good setup. This is not a good setup. We don't want it. Okay. we're looking for this. The lines are really far apart, market is strongly trending. And what we're looking for is basically a pullback. And the way that we're going to identify that it's a pullback is that it's going to touch the 21. And so it goes over the 21 like this, and we're like, okay, we're interested. And then when price exits it, this is when we enter. It goes up and back out. So we would enter something like this. Like say we got the alert here. We'd put our stop loss above the recent high. And what we're looking for is maybe somewhere price has been. That was our stop loss. Okay. This would be a good one. This would be pretty doable. Let's see if we can go back any further. No. Okay. So if you're mapping this out, I would say we're going to look for like this. We're assuming price might go back to here. So in this particular case, this is only a 0.81 risk to reward, so it's not actually that great. And as you can see, this move went a lot further. Which is not saying that you should try to grab the whole move, but maybe what you do is you set this as an initial target, and if price is still moving really strongly, you continue, or you just take a small target. It's up to you. This happened here. You can see price touched again here, but let's assume you're already in that first trade. Price had a really strong pullback here. Maybe you entered another trade here-ish. Really want a candle close. And let's say you target this. So get a nice 1-to-1. Here's some options for you. All right, and then you can see here, price broke our 21, came back down, and this one would have been a loser, 100%. Like it bounced, and then it came back through, broke through, and ended this downtrend. So our strategy is not 100%, but honestly, it's a great one to start with. It works in a lot of cases, right? If you look at this downtrend here, this would have been boom, win, right? Like these are great. You have to figure out your own take profits, your own whatever. But this is a really good basis for a strategy that people use all the time. And all right, y'all. It's the basics of EMAs. I hope that helps you. Moving averages are a really great tool to use in day trading. A lot of people prefer them over much more complicated indicators because they're just simple. They just show you what price is doing. You wouldn't even have to be using this, but it really adds a lot of depth to your chart without making it too cluttered at the same time. The key here is practice. Pull up your charts, add the EMAs, play around with it, map out some good trades, and then try paper trading. Today's video was a great beginner's course in moving averages. I've got plenty of other beginner-focused videos. If you want to learn about candlestick types or some basic candlestick patterns, click on the links. I hope you enjoyed the video. My name's Andrew, and I'll see you around.